Okay, good evening. Warm welcome again to day three of our comprehensive technical analysis webinar. I trust all of you are having a good time and the progress so far has been satisfactory and it has been a great learning experience so far. We have covered on day one basics of why and how technical analysis works. We went through the market pyramid, the market cycle. We also looked at the Dow theory, and then we introduced you to the concept of support and resistance. And then on day two, we followed that up with a way of trying to define support and resistance using trend lines, straight as well as curved. The curved trend lines, we use the moving average system, and these would have helped you to define the trends better and in a manner where we can progressively take advantage of the trends as they unfold. On day one, I showed you the horizontal kind of mapping method where we used the past highs and lows and push them out into the future in a horizontal manner, and then we found that substantial number of future pivots were all happening around the same levels. Then on day two, we used the slope trend lines where we joined two support points, which is two lows, and then extended that out into the future. And we used also two highs to draw the resistance trend line and push that out into the future. And like I mentioned, and you might recall from yesterday, that since two lows actually carry positive charge of being support points, the trend line along its entirety carries the positive charge and acts in that manner on prices when they are approached again. In a similar fashion, the resistance trend line carries a negative charge, and it will act upon prices when it is approached to send the prices to the downside. And in the course of this discussion on support resistances, horizontal levels, as well as slope trend lines, and of course the curve trend line using the moving averages, the basic point which was highlighted was that support and resistances are two levels that are assigned a certain job in the marketplace, and the job is for support to send prices up and for resistance to send prices down. Now, if you give somebody a job, you want to see that that person does it. If he doesn't do it, then he's not capable of doing it, or the forces arraigned against him are larger than what he can handle. It's just like, let's say, a chowkidar in your building can perhaps ward off, a person or two, but then if a group of guys were to come on an attack, the chowkidar would rather beat a hasty retreat or not bother to stop them at all. In quite the same manner, prices along their pathway build up supports and resistances, and these seek to halt the movement of prices as they go along. Periodically, they will be overwhelmed when you have, a surfeit of either demand or supply. And at such points of time, the support or resistance will give way. And if the support gives way, the prices will fall to a lower low. And if the resistance gives way, the prices will rise to a higher high. This is what was the concept or underlying principles of the trend element, trend definition as per Charles Dow, that a uptrend is a series of higher highs with higher lows. Now, when you have higher highs, it indicates that resistances are being overcome, and that means there is demand at higher price levels. Alongside, the lows also get pulled up, which indicates to you that people who are buying this particular stock or that market are in a hurry to buy, and they do not exercise the patience to see the prices come back to former lows, and instead they are in a bit of a hurry, so they push up their buying levels higher. That is how the bottoms become higher. So higher highs, willingness to buy at a high price level, paying higher premium. Higher lows, willingness not to wait, or rather unwillingness to wait for previous lows to be reached, indicating a certain sense of impatience amongst the players to buy or own that stock right? So this is how higher trends are formed, and that is how we get an idea from looking at the charts that what people are thinking and what they are doing in the marketplace. And depending upon how they think and how they act, the prices will form, and the prices get printed on the charts. And sitting in the comfort of our homes, we are therefore able to spot what people are thinking and doing across the marketplace. And once we know how people are thinking and acting, we can create a pattern out of it to see whether they are thinking and acting in the correct manner. So, for kind of designing a pattern around it, we use the moving average lines, use them from the perspective of support and resistance, and saw whether supports were holding or supports were breaking. If supports were holding, we know that people continue to act in concert, and the stock prices would continue higher. But in the event that the supports were to break, we are made aware that the buying force is either not sufficient enough, or perhaps the selling force is numerically and resourcefully larger, and therefore the support has been overcome. And both these send out to us a certain kind of message which enables us to act with certain degree of precision in the market, certain amount of foreknowledge of what is to follow. And that is how this entire process of support, resistance, holding or breaking becomes of forecasting value. And that is what we seek from technical analysis, or indeed any form of analysis. We are always looking at past data, acting in the present with an eye on the future. But when we look at the present, and the present speaks to us through the charts, through the formations, through the patterns, and we are able to discern a certain pattern, and then we are able to know what is statistically possible, what is reliably possible for the immediate or the unfolding future, then we are enabled to act in a certain manner that shall become beneficial to us. So this is the whole game, and what shall follow ahead will continue this process of trying to identify supports and resistances and make forecasts of where future supports and resistances shall lie. In that course, we looked at channels as well. We looked at a variety of channels, and the simple channel, as I showed you through examples, you could spot that they work wonderfully well, and to an extent that you must use the channel method by default. As soon as you get two lows, draw the support trend line and go to the high in between the two support trend lines, and you should then draw a line which is parallel to the support trend line to create a channel. That channel acts as a potential price target for you to aim at, so that you can plan the risk as well as the reward of your trade. And this makes your entire trading activity or investment activity so much more well planned and structured, rather than simply rely upon gut feel and somebody else's prompt for you to either act or not act. So this way you get to be control of your own affairs, and that is the greatest value that you shall derive from learning technical analysis. The more you learn the methods, the more you will find yourself to be in control. And I'm sure at the end of this complete program, you will actually come out of this entire program a much wiser and a much more confident person, able to handle your own in the world of investments and trading, right? That is the skill you want to build on subsequently through further learning, further reading, further attending of seminars, and considerable amount of practice. That, of course, goes without saying. Anything that you hear is going to stay with you, as this as research goes, at the most for about 20-21 days. If you do not put the thing into practice quickly enough, the chances are that you will very soon forget what you heard or what you thought you learned. So at the end of every session, you need to go to your charts and start to apply what you have learned from the sessions, right? Unless you practice this and keep practicing them diligently day after day after day, this will not really get seated into your mind, as it were. And that is what is required for this to become a process for you to apply every day of your life in the markets. And I assure you that if you are diligent enough with this effort, you will come out considerably better as far as being a successful trader or investor. All right. So let's now dive into day three. The subject matter for day three is candlestick charting. If you recall on day one, when I was speaking about the different types of charts, I mentioned to you that candlestick charting is one of the ways of charting. Candlestick charting came to the attention of the Western world only somewhere in the mid 90s, although they have been in existence from somewhere, we are told, 11th or 12th century in Japan. So they are called Japanese candlesticks because the origin is from Japan. And the candlesticks are using the same set of information, which is your open, high, low, and close as your data. And as you can see here to the right, I have shown you the picture of two candlesticks. They have been designated as bullish and bearish candlesticks, and that is what makes them immediately sort of different from your normal bar charts. Your bar charts, unless you look at them very, very closely, it'll be rather difficult for you to discern which bar is bullish and which bar is bearish. But with the candlesticks, the visual acuity accorded by the pattern is so much greater that you are able to make out immediately which is a bullish candle and which is a bearish candle. Now, as you can see that you have the same data point, open, high, low, and close. This is the four same data points that the bar also use. But in the candlestick, there is a small change which is actually created, and that is what creates the body and separates out the bar into a body portion and a portion which is called as the wick or the shadow. Now, if you look at it in this chart here, this portion is, excuse me, this portion is your body, and the portion related to this area here is the wick, right? So you got the wick of the candle, and this portion is called as the body of the candle or called as the real body. So the shadows which are placed on the upper side are called the upper shadows, and the shadow which are placed below the body are known as the lower shadow. Now you can notice that the portion between the opening price and the closing price is widened, and this widening is what gives it the shape of a candle, and hence the name candlestick charts. Okay, and this widening or the real body of the candle is given two different shades, which is what differentiates the candle from being a bullish one and a bearish one. And the differentiation is fairly simple. If the close of the day is higher than the opening price of the day, then it stands to reason that the market opened and traded to the low, to the high, and generally finished much higher. So the people's thinking process at the end of the day is somewhat or considerably more bullish than what it was when they began the day. And therefore, that particular day is designated as being bullish, and a certain color is ascribed to it. Very typically, they are either shown as blue or green. These are the standard colors depicting bullish candles. In non-color monitors, which of course today do not exist, they used to be colored white. And if you read the textbooks or read the older tomes, bullish candles will also be referred to as white candles. Okay, so white or green or blue is the typical coloring of a bullish candle. Now, if you come over to the bearish candle, you can see that the closing price is lesser than the opening price, right? So, what has really happened in the market today is that the markets opened at this price level, traded initially to form the high, and subsequent to that, they started trading down because there's something change in the marketplace in terms of the equation between the buyers and sellers, and the sellers began to dominate, and they started pushing the market down and carried the market lower. And then they went on to record the low of the day, and by the end of the day, they finished at a point which was considerably lower compared to the open. So when the close of the day finishes below the open, the candle or the trading pattern for the day is said to be bearish because people are going away for the day a little worse off than what they came into the market with in the morning. So when the mindset, so the opening and closing prices are really measurement of the mindset of people at work. In the morning, when you come in, you have the mindset carried over from all the thought processes that you engaged in from the closing of the market yesterday, all through last evening, what and into today morning, whatever you read in the papers, what you spoke with your friends, your analysts, etc., what you heard on TV, all those things form your opinion at the open. And then during the day, so many other inputs are received, and the market trades to record its high, record its low. But as you gravitate to the close, you now start to take in all the things that you came to the market with at the open, combine all that with whatever transpired during the day, and then towards the end of the day, you start building in expectations about tomorrow. And therefore, the closing has an additional element compared to the open, that there is also a certain expectation built about what shall happen to the market tomorrow. So the closing price is therefore the most vital of all the four data points that you have amongst open, high, low, close, because maximum amount of thinking goes into formation of the closing price. Also, the closing price is significant from the fact that it is used everywhere. It is used to decide mark to market. It's used to define whether the markets were higher or lower. It is used in a variety of places. So therefore, the closing is the most widely used or accepted form of market data, and therefore the most amount of accent in candlestick is between the opening price and the closing price, because so much of additional thinking goes into it. If you see it from that angle, highs and lows are merely transient points, right? They do not really show up when no one, like for example, places an order with a broker saying that please sell me out at the high, or please buy my share at the low, right? Such an order is not possible to be executed. But most often, the kind of orders that you do receive is buy me at the open, sell me at the open, or buy or sell at the close. These two are very distinct, let's say, time points and price points in the market. And that is why Japanese candlesticks really concentrate upon the relationship between the opening and the closing price. And that is why the area in the data points as being drawn on the chart are widened between open and close to create the body, the real body, and the excursions to the high and the low are shown as small thin lines which create your shadows. All right. So this is the basics behind which all the candlesticks operate.